Welcome everybody, my name is Jerry and today we're going to talk about futures trading. I get a lot of questions from family members, friends, people that I've worked with. Eventually, we get into conversations and it comes up that I trade futures. I trade all kinds of futures. I've traded futures for quite a few years now. And, for a lot of people, they have no idea what that is. And considering that during this time, this is during the coronavirus time, so you may be watching this in the future and we're long past the coronavirus, but a lot of people want to know how to make some extra money, even if we're not during the coronavirus. People just want to know how can we make some extra money, and is futures trading something that they could do? So today we're going to cover, just in this video, I'll do, this is going to be a series of videos because this is a very in-depth subject matter. And today we're going to talk about just two things. What is futures, and the second thing we're going to talk about is mark to market. So it's really, really important to understand these two basic premises. What is a futures and what is mark to market? Those are really important to grasp, these two concepts. Now, before we get started, yes, I trade futures, but I need to say right here that this is for educational purposes only. I'm not giving out advice, so you trade at your own risk, okay? But I do believe you can learn a lot by just simply watching this video series I'm going to put out. Now, I don't normally do these things on my YouTube channel, but since a lot of people are asking, I thought I'd go ahead and do this. So, first of all, is futures trading easy? No, it's not easy. In my opinion, no, it's not easy. And is it risky? Yeah. Yes, it is. It's risky. So it has a lot to do with your desire. Are you willing to learn what it takes to be successful at futures trading? So some of you may trade stocks, some of you do not, but let's do an analogy here to try to keep this as simple as possible. If you're buying stock or trading stock in the stock market, the very simplest version of trading is you buy the stock when the price is low. Let's just say you buy, I don't know, Procter and Gamble. Pick any big company, Microsoft. Okay, pick whatever you want. Let's say you buy it at $10 and the value goes up to $20. If you bought one share at $10 and then you sold it later at $20, well, you made $10, right? That's the simplest version. You buy low and you sell high. That's stock. And we're going to stay away from shorting stock. That's a conversation for a different day. Which personally, I do not recommend shorting stock because the leverage is horrible, and we're not going to get into that today. I just think shorting stock is very bad use of your money. If you're going to short something, you might as well short futures. Okay, so that's stock. Stock is pretty simple. You buy low, sell high. Now in futures trading, it's much more complicated than that. The difference is in stock, you have only one or two things to think about: the quantity of shares you're buying and the price. That's it. That's all you're worried about. I bought 10 shares. Where's the price? Am I in a position to make money or lose money? If I sell it now, will I make money or lose money? That's how simple stock trading really is at the very basic level, okay? So in futures, so that's just basically, think about that. It's just two attributes: the quantity of shares you own and the price of those shares. That's it. But you can see in front of you on the screen, in futures trading, there's a lot more involved than just the quantity and the price. So let's look at number one. What is a futures? What is a futures? What is that? Well, it's an agreement. Specifically, it's a contract. You can think of it as an agreement between two people, even though it may not actually be between two people. But just to keep it simple, it's an agreement or a contract between two parties. And like any contract, there's going to be specifications or conditions that go along with this contract. Okay? You don't have to really worry about the who's the other person on the other end of the contract, because that's all handled by um, it's really handled by the trading houses, if you will. Okay, you don't have to worry about who's on the other end. That's not a concern. Just know there's somebody or some entity on the other side. It doesn't really matter who that is. Okay. So let's look at a specific contract product, or I should say a product here. You'll see E-mini light sweet crude. It trades under the symbol QM. Okay. So what are some of the specifications or conditions for this type of contract, the light sweet crude? Well, we have initial margin requirement. This is really, really important. Now, currently, the initial margin requirement for light sweet crude, E-mini light sweet crude, has gone up significantly. Went up about $1,000 because oil right now, we are in April of 2020, and oil is at near its all-time lows because during the coronavirus everything has crashed. So, for one contract, you'll see there initial margin requirement. You have to have $3,520 in your account just to trade one quantity or one contract. Okay, so if you don't have that kind of money, then obviously you're not going to trade light sweet crude. But there are other products, futures products, that are much cheaper. So I'm not going to get into all that right now. We're just dealing with an example here. Okay. The next thing I want you to look at is, even though it says A twice, it should be A, B, C, D, E. Sorry about that. But the next one down is expiration date. Yeah, unlike stock, there's actually an expiration date associated with these contracts. So the contract will actually expire. It's an agreement that lasts for a defined amount of time. You need to really understand that. It's very important. Okay? You have a limited amount of time to trade these contracts. Okay? You can't hold on to them forever like you do stock. Okay. Currently, the most relevant contracts being traded for this particular product's light sweet crude are June contracts, which expire May 18th, 2020. I know that's weird, but that's the way they do it. So you can already see just with the first two attributes, the first two specifications, you really got to pay attention, right? They're June contracts, but they expire in May. Some people get confused by that. Just focus on that May 18th date. That's the last trading date. Okay. Okay, then the next one down is units per contract. Now, the type of units that we're dealing with in light sweet crude are barrels of oil. So there's 500 barrels for every contract. That's a whole lot of oil. Okay, that's a lot of oil. 500 barrels. When you buy a contract or sell a contract, you're trading 500 barrels. Okay, the next one down, C, is called tick value. That's the minimum value that the contract will move up or down. In this case, the contracts can move up or down 2.5 cents. Okay, and they could move 5 cents, 10 cents, whatever. They can move a lot, but the minimum amount it can move is 2.5 cents for this QM symbol. Okay, then D is the dollar value per tick. You'll see it says $12.50. So if the price, or the tick value, which is also known as price, if it moves 2.5 cents, that's $12.50 worth of movement. Okay? So for anybody that's never traded futures contracts, already most of you are shaking your head going, what the heck is he talking about? What is this A, B, C, D, E stuff, or A through D? What is this margin requirement, initial margin requirement, expiration dates, the number of units per contract, tick value, dollars per tick? What is all this stuff, right? There's a lot to consider when you are trading futures. And that inherently is why trading futures is much more complicated than trading stock, because you have to take all that into consideration, and even more than that. But that's the bare minimum right there. So number one, we've talked about the conditions or the specifications of a contract. Okay. All right. Now let's talk about mark to market. Stock, its value is whatever the value for the given day when the stock market closes. That's the value of the stock. And the value of your brokerage account goes up or down based on all the different stocks or stock that you have in your brokerage account, right? So again, if you're trading Microsoft, let's say, or CBS, or Procter and Gamble, or pick any company you're trading stock in, if the value of the stock goes up, then your brokerage account value goes up. If the value of the stock went down for that day, then your value of your brokerage account goes down. Okay, but, and this is a big but, no pun intended, you need to really understand this next thing I'm going to say to you. The true value that you have in your account only occurs when you sell the stock. If you have 100 shares and you sell those shares, then you get cash in your account. Again, if the price of if when you bought it was $10 and the price went up to $20 and you sell those 100 shares, then obviously you made money, right? The value went up. Correct? 100 times 10 would be $1,000, but 100 times 20 is $2,000. So you would have made $1,000. Okay? And that's the true value of your brokerage account, is when you actually sell the stock. Okay? And if there's nothing else going on in your account, you're not going to be at risk of your broker saying, talking about margin calls. Okay? You're just the value of your accounts going up or down based on the value of the stock. That's it. Your broker doesn't really care. Okay? You don't really lose any money until you sell the stock. If the company goes out of business, then of course, that's a different story. But that's the simplicity of stock. Now with futures, there's a thing called mark to market. And what is the difference? The difference is at the close of trading day for futures, in this case, this particular light sweet crude in front of you, this closes at 4 o'clock p.m. Central Standard Time. I'm in Texas, okay? It'd be 5 o'clock East Coast time. Okay, just like stock, the contracts will be valued at the last trading price for the day. Again, like stock, this means your brokerage account will go up or down accordingly. However, the difference here is if your account assets or cash is less than the brokerage account value at the end of the day, then you're at risk of what's called a margin call by your broker. So unlike stock, the broker is looking to see if you have enough money in your account to cover the value of your brokerage account. Let's say in light sweet crude it went from $10 to $20, it went up, then you're going to be fine because the value went up. You're not going to be at risk of a margin call, right? But if the value went down, let's say it was $10 and went down to $5, that means you lost $5 per, we're not going to get into the math just yet, but basically if the price of oil went down $5, which by the way would be a big move, okay, the broker has automated systems in place to check to see if you have enough assets and or cash. Assets would be other stocks or bonds or other things that could be converted into cash if they're sold, right? It's going to check to see, do you have enough money or assets to cover your value, this value loss in the futures trading. So mark to market simply means that the futures contracts will be valued according to the last trading of the day, and you better have enough money or assets to cover any losses. That's right, even if you didn't actually sell the futures. Okay? Unlike stock, the broker doesn't care whether you sold it or not. It only cares what the value of that futures was when the market closed. So you can see there's a big difference, right? You could think of mark to market as almost the same as selling the futures. From a broker's standpoint, it's almost the same as if you were to sell it at the last price of the day. And then you calculated the value of your brokerage account. Okay? That's the way the broker looks at it. You can almost think of it as a virtual trade without actually trading. Okay? It's a theoretical trade that never really happens. It's just their way of the futures market's way of marking your futures value. Okay? So really important to understand that. It's not like stock. You can't just hold on to it forever and everything's going to be fine. You've got to pay attention to the value of those futures contracts. Okay? And you have to mitigate or manage that. In other words, if you can determine before the close of the trading day you're not going to have enough money or assets to cover the price that you think the futures are going to be at, you might want to deposit some money into your account, or you might want to sell those futures contracts and get out. But just know this, even if you sell your futures contracts, if the loss is so great, you could, in theory, owe the brokerage firm money. Because remember, futures trading is always done on margin accounts. You cannot trade futures on cash accounts. It has to be a margin account. So if you have a cash-only account, you can't trade futures, and you're going to have to apply for a margin account. Okay. All right, that's as far as I'm going to go today because this is already about 15, 20-minute long video. So we're going to go to the second video. Just follow along in the series of videos as I put the videos out. But I suggest you go and do your favorite search engine, or go on your broker site, wherever, and really get these two things down. What exactly is the definition and specifications for a futures contract, number one, and number two, what is mark to market? Understand those two things. Now, just real quick before I finish, number one, remember the actual numbers I'm showing you here, that's only specific to E-mini light sweet crude. If you're trading corn futures or gold or silver or platinum, okay, or wheat or the E-mini S&P 500, you name it, those numbers will always change. For every single product, it changes. So unlike stock, you've got to know the specifications for the specific futures product you're trading. Okay, that's it for now. I hope you really enjoyed the video. Listen, if you haven't subscribed to my YouTube channel, go ahead and click subscribe and click that notification bell so you can keep up with all the videos I'm going to be putting out. And we'll talk to you all again real soon next time.